Inflation in the economy is clearly trending higher. Wholesale price inflation rose to 3.5% in October compared to 2.6% in September. Rising inflation and risks to government finances are sending bond yields higher. Ira is pulling up a couple of charts from the Bloomberg to tell us what really is going on in the markets. Ira.
Right, so there's inflation, there's tight liquidity, and there's global bond yields. Those are some of the factors that are impacting the bond markets here back home. This is the inflation number, just putting it up for you. 3.59 is the number that you got for wholesale inflation for the month of October. The retail inflation numbers had also shown a trending higher. It's fuel prices that are feeding in, also higher and slightly normalizing prices on the food front are starting to feed into inflation. But that's not the only reason you're seeing bond markets starting to look nervous. So if you pull up this particular chart, it looks like bond yields are trending higher, partly due to liquidity. And the domestic market guys are saying liquidity and the fact that the RBI is continuing with its open market operations is the primary factor driving up yields. But if you look at this chart, oil seems to have been the other big factor which has pushed up bond yields. So 10-year bond yields have moved up pretty much in conjunction with Brent crude prices at a time when inflation is anyway normalizing. Higher oil prices are perhaps the worst thing for the bond markets, and also from an inflation growth scenario. Remember, because we don't have clarity on growth, so if inflation starts to pick up, growth remains shaky, you're sort of stuck in a little bit of a quagmire there. The other thing to point out is that while yields are rising back home, we are not the only country or the only market that are seeing a pickup in yields. So some of the other markets, just pulled up a couple of representative charts. China, for instance, the 10-year bond yield there went up about 4% for the first time in a very long time, and even a country like Malaysia has seen some pickup in bond yields. Individual domestic factors at play, but also perhaps a slightly broader global trend which is at play. Developed market yields and developed market bond scenario has also changed a little bit. And to highlight that, just pulling up this chart which is giving you a sense of the US yield curve. The US 2-year yield to 10-year yield chart is showing you that the yield curve is flattening, and that will have some implications as well globally. Joining us to talk about what's happening on the bond side globally and domestically is Vivek Rajpal. He's India rate strategist at Nomura, joining us on the phone line from Singapore. Vivek, thanks so much for talking to us. Great to have you. Let me start with India first. We took out 7%, which was important, I guess, from a psychological perspective, but some people tell us also important from a technical perspective. What's your view on 7% rates and how we've come this far?
Well, I think you have mentioned a few important factors. I'd just like to point out a few of them which are impacting the markets. I think most importantly, the factor number one which is impacting the market is fiscal uncertainty because of GST. There is uncertainty on the revenue collections, and there is uncertainty on the fiscal front, which effectively means that there is uncertainty on the bond supply. So we don't know exactly how much will be the bond supply in quarter four of this fiscal year. So that is number one factor which is impacting bond markets. Second factor which is impacting bond markets is RBI OMO sales. RBI has been continuously doing OMO sales, and they have already done close to 1 trillion. Given that there is already so much supply pressure, RBI's OMO sale actually adds to that supply pressure. And then number three, really, market is also pricing out any kind of a monetary easing expectation, which is because of a rising inflation trajectory as well as the higher oil prices. So these are the few factors which are impacting India rates market, and these are the local factors that I'm talking about. It is worth mentioning here that a lot of central banks in Asia, like Korea, Malaysia, etc., have already sounded hawkish, and there is a theme building up that we may be entering into a phase where a lot of central banks will enter into a policy normalization, and which is also having a spillover effect on India bond markets.
Vivek, you spoke about what global central banks are doing. What about our central bank? What do you think, the RBI, how is the RBI going to be looking at the situation? The CPI number, many people believe that this 4% plus level is going to continue. Does that dim the hope of a rate cut?
Yes. So I think RBI has made it clear many times that it is targeting 4%. Now, because it is targeting 4%, any inflation reading or any stable inflation above 4% is something which means that there is very limited, or rather negligible chance of a further rate cut. I mean, to be frank, India is operating at a very high real yield relative to where we are seeing inflation. But then, given the supply pressure that Indian bond markets are facing, and given the fact that inflation will stabilize above 4%, I mean, there should be limited hope of monetary policy easing expectations.
Vivek, two questions. One is, what is your own call on Indian bonds? Do you have targets in place for the 10-year which may have changed because of the changing scenarios and the factors that you mentioned? I noticed while I was talking to you that the flows on the bond side are negative so far this month for the first time since January, a small negative, about 1,000 odd crore, but still negative after a very long time. Are foreign investors starting to turn negative on Indian bonds?
No, I'll to answer your questions, one, I have been calling for a steeper yield curve, and this is exactly what we have seen. But I would have expected bond yields to stabilize around current levels. I mean, I personally think that 100 basis point of spread over the repo rate is something which should be seen attractive from a buy and hold perspective. I think traders should avoid this market because market is always prone to overshoot or undershoot in one direction. Nevertheless, from a very medium-term perspective, if we are actually if we will see a stable inflation of 4.5%, and if RBI is expected to stay on hold, which is our base case, then 100 basis point of a spread over repo rate is something which should be seen very attractive from a medium-term perspective. Now, second question is foreign investors, they have started selling. So yes, I mean, actually, what is one of the most interesting facts is that October was the month when debt outflows began in the rest of Asia. Correct. India was only exception in Asia. But in November, what we are seeing is that dynamic or that spillover effect is coming into Indian bond markets as well. I think a lot of foreign sentiment is actually driven by the oil prices. And therefore, I wouldn't be surprised if the foreign flows get correlated with what we see in oil from here. So, for example, if oil actually falls, I would see a foreign investor coming back into the Indian market. But if oil continues to rise, we should see foreign investors actually leaving or selling Indian bonds.
Okay, Vivek, just one last very quick question. Are there implications of the flattening of the US yield curve on flows into emerging market bonds?
Right. So I think what is important is that US curve is flattening, but it's bear flattening. So in the sense that 2-year yield is rising more than the 10-year yield. And unless there is a terminal rate expectation change in US, yield curve typically flattens. So let me tell you that that bear flattening is still okay for Asian bond markets. If we start seeing a bear steepening kind of a scenario in US, that will be very, very detrimental for Asian bond markets. And my base case is that the trend of bear flattening that we are seeing, which effectively means that Fed will continue to tighten, whereas terminal rate will probably be stay where it is, where the market is pricing. If that plays out, that will continue to play out. So. Given a choice between bear flattening and bear steepening, I think bear flattening is still an okay scenario for Asian bond markets rather than bear steepening.
We will leave it there, Vivek. Thank you so much indeed for taking our call. Vivek Rajpal from Nomura talking about what's going on in the bond markets. Yields have spiked about 7% for the first time on the back of the inflation data that came in late evening.